All right, we know that negative traction on the equity side of the market. Is that the case on the fixed income side of the market?
Well, in terms of a fixed income market, once the MPC decision was made, there was a rapid rise in prices, so yields have fallen significantly over the past few days. So for people who already have exposure to fixed income markets, they've made some good capital gains this week.
Explain that to us, because the MPC effectively decided to keep rates unchanged, cash reserve positions unchanged.
Yes, in terms of the decision, quite a number of people expected a rate increase in the MPR, primarily because of the stubbornly high T-bill rates and a bit of arbitrage opportunities in the market. But the central bank, and also the increase in inflation, but the central bank decided to stay the course, and there's no MPC meeting till, I think, January. So given the fact that there's no chance of any MPR hike over the next several weeks, the fixed income market started to rally.
All right, you say bond yields have fallen. DMA's auction in the last week for the 2018 and 2019 papers, how have they performed?
Sorry, I didn't get that.
The DMO's auctions, the papers that have come on stream, how have they performed?
Well, yes, I mean, if you look at the auction last week, we were both at 16.5 for 2018 and 2019. For the 2018, those yields have come under 15% now. So some decent appreciation for the buyers of those instruments at that auction. 2019 is not yet very liquid because not very many people hold it at these levels. Most people hold it at much lower levels and will refuse to sell right now.
What do you expect to see by way of trends in bonds into the rest of the year, into early 2012 as well? Because as you're saying, rates have remained unchanged given the MPC's decision.
Well, that's a tricky one. I mean, on the short end, I mean, T-bills are still relatively high. I mean, the yield curve is still inverted. But when you see what's happening with the 20-year, 20-year has now gone back below 13% yield. 2015 is below 13%. These yields have come down significantly, and it's unlikely that they're going to go back to the October levels where the 7-year bond was auctioned at 18%. So we'll probably remain close to these levels or just slightly higher between now and year end.
All right, now we know that there have been no subnational or corporate bond issues coming into the market. What impact is that going to have? Because the big issue about Nigeria is to deepen the bond market. So you need to have some of the federal states coming to the fore. You need to have companies coming to the market.
Yes, I mean, in terms of those other issues, the corporate and state, I mean, since early October, no activity, primarily because of the extremely high FGN rates, which spiked in October with the 7-year going for 18%. Clearly, if the FGN is 18%, what will the state be? I mean, using historical spreads, that would have taken the state bonds to 20%, and nobody was prepared to issue at those levels. Now that the yields have come down substantially, we are getting to the point where a few states who have been on standby could be encouraged to come forward at an attractive rate, better than FGN rates, but significantly less than where they would have had to price in October. So hopefully by year end, we might have probably 2 or 3 states close their bond transactions. Corporate side, probably not a lot of big activity. The corporates can still borrow a lot cheaper from banks than the cost of issuing debt in the current market.
What sort of incentives, if incentives is the right word to use, is needed to bring some of the corporates on stream in terms of bond issuances, to bring some of the federal states onto the system?
Well, in terms of the states are all working on it. I mean, different states are at different points in the process. There are probably about 10 state bonds in various stages of completion. And there are probably another 10 that are looking at very closely at issuing bonds. So the states are not really the problem. They're just a bit price sensitive right now. But for the corporates, I mean, until the full weight of the MPR hike finds its way through the system and the banks are charging some of these blue chips significantly more for their loans, they simply will have no incentive to issue. Some of the lower quality names might be forced to come forward because they'll be the first to see their loan prices fully reflect new MPR levels. So probably in the next 6 months or so, we'll start to hear more bond transactions, at least in the process of coming to the market.
I mean, obviously, liquidity is an issue, Egie. Some investors have often said if you're not buying if you're not buying federal government bonds, you've got a bit of a problem on your hands. You've got to hold the papers to full tenure because you can't really cash it into the market, those sorts of issues. So going forward, authorities have to act. But what else could be done to stimulate a little bit more interest in 2012?
Well, I mean, in terms of for some of these, yeah, the liquidity in the state and corporate market is not that good. But again, it's a function of the depth of the market. Even for the federal government bonds, there are many of the issues that have no liquidity. Because when you have a federal government issue with only 30 or 50 billion outstanding, you're not going to have lots of trading in that instrument. Same kind of idea applies to the states. But as you have more and more states issue bonds, and as you have a deeper market, you'll probably see secondary market activity start to evolve. There is some secondary market activity, but it's not as extensive as we would like it to be at this stage.